Anyone who follows my work in Barron's or on our weekly Barron's Roundtable show knows that banking is my favorite sector to cover.
Colton knows her banks. Thank you so much for that.
Few, if any, industries have their fingers so firmly on the pulse of the economy. But this year, covering banks comes with fresh challenges. For much of the past 2 years, bank stocks mostly went straight up after overcoming the worst of the coronavirus pandemic. While there are always winners and losers in any sector, investors were generally rewarded for sticking with a bank index fund and reaping gains as the economy recovered. But bank earnings results for the fourth quarter of 2021, coupled with management outlooks for 2022, hint that we may see more divergence in the sector this year, and investors may want to take more of a stock-picking approach. Here are 3 things investors should focus on in 2022 when making their stock picks. First, the impact of rate hikes on banks. Wall Street expects that the Federal Reserve will lift interest rates as many as 7 times this year to tame rampant inflation. Banks are one of the few sectors set to benefit from the Fed tightening monetary policy. But not all banks will benefit equally. Money center banks, which derive much of their revenue from bread and butter banking, which is to say taking in deposits and making loans, will benefit most from rate hikes. This is because their net interest margins, which is the spread between the interest they earn on loans and the interest they pay out in deposits, will widen and boost profits. In fact, Bank of America said that a 1 percentage point increase in long and short-term interest rates would improve net interest income by $6.5 billion. Pure play investment banks may have a tougher time. Volatility in equity and bond markets spurred by rate hikes could help banks' trading desks, but a sudden increase in interest rates would make borrowing costs more expensive, meaning that merger activity may slow down as many deals are financed with debt. Second, tracking loan growth. Lending is another area where money center banks can outperform investment banking peers. Loan growth was flat to negative for most banks over the past 2 years, as many potential borrowers were feeling flush with cash thanks to pandemic stimulus. The fourth quarter of 2021 showed improving lending trends for banks as some of those cash stockpiles dwindled. While an increase in interest rates may curb some borrowing, particularly for mortgages, the picture isn't totally bleak. So long as the economy continues to show signs of growth, households and businesses will borrow. Investment banks, which derive less of their revenue from lending, won't benefit as much as the money centers, however.
Full of all the nerve.
Finally, keeping expenses under control. It's no secret that everything costs more these days, and banks are feeling the pinch too. Even though for months banks have been announcing pay increases for employees in an effort to recruit and retain talent, Wall Street was still surprised when most banks reported ballooning expenses for the fourth quarter of 2021. Even worse, many banks hinted that expenses will remain elevated as they pay for talent and invest in technology.
Is called an electronic computer.
But rising costs aren't necessarily a death knell for all banks. Investors should focus on banks that are able to offset higher expenses with increases in revenue. Investors will also have to discern if some of today's costs could be considered investments in future productivity, particularly as banks work to improve their in-house and client-facing technology. There's a lot working in banks' favor this year. The SPDR S&P Bank ETF is up about 7%, while the S&P 500 has fallen 6%. But even in a strong sector, investors will still want to be choosy.